Market recovery continues. It's been a good afternoon for the bulls after a long time. Varun Goel, Senior Equity Fund Manager at Mirae Asset Investment Managers, is with us now to take the conversation forward. Varun, great to have you with us. Hope you had a good Diwali. The bulls are really hoping for a break, and at least this afternoon they've gotten one. What have you made of the market correction? I mean, index level, we're talking 8-9% lower. Individual stock level, it could be much deeper. Have you been deploying more cash? What is the cash position, first of all, within some of your schemes now? And have you been using the dip to buy, or are you still being a little cautious and being on the sidelines?
Good afternoon, Suvi. Diwali wishes and the New Year wishes to you and all the team and all the audience. I think the broader market correction that we have seen unfolding in the month of October is actually quite healthy. Valuations were running a little ahead of fundamentals. I think, especially in some of the mid and the small cap space in sectors like PSU, defense, railways, some of the capital good names. I think it's a lot of froth is getting cleared up. As far as Nifty is concerned, if we look at the earnings, we ended with 1,000 rupees EPS. For FY24, and for this year, our sense is we will end up with around 8% earnings growth, which is a slight scale down from what in the beginning of the year the expectations were around 10-12%. But overall, I think the larger earnings growth trajectory remains intact. For the next year, we expect 12-15% growth. So I think FY26, which is what market is discounting now, we are looking at around 1250 rupees earnings. And on that basis, market is trading at around 19 times 1 year forward, which is 5 to 10% more expensive than the historical average. But looking at how the interest rates trajectory is, looking at how the domestic flows are, I think we are broadly comfortable. So I think from a medium to long term perspective, the market gives good opportunity for a healthy double-digit compounding. And we continue to be invested. As far as the cash position is concerned, as a policy, we never have too much cash. I think most funds running with low single-digit cash, and we have been, of course, deploying cash as the market has corrected.
But do you think there's more froth which needs to get corrected?
Well, there are individual pockets. As I mentioned, there were some sectors which were clearly running away ahead of fundamentals, and capex and infra as a theme has done particularly well in the last 3 years. I think that correction has been unfolding for the last 6 months. I think some more may happen. But I think broadly now we are in a regime where, if you go back 30 years, Nifty earnings have compounded at 10-12%. And if you would do good stock selection, you do good risk management, there is scope for healthy double-digit kind of compounding. And I think the markets will go back to prudent risk management, good stock picking. I think the important thing is we have to set our expectations right. Last 4 years, Nifty earnings grew at 18 to 20% CAGR. I think from now onwards, we are looking at more like low double-digit kind of earnings compounding, and therefore expectations need to be scaled down. But I think broadly still, a low double-digit return is also a very healthy return, and I know that's also something that investors should look forward to from a medium to long-term perspective.
Hi Varun, good afternoon. Good to see you. And Varun, if I'm not mistaken, Mirae has a Chinese fund as well.
Yeah, we do have global funds, but I'm not the best person to talk about those. So I look primarily at the domestic.
I just wanted to understand, how do you weigh the two? The problem is India was the only game in town till say around 2 months or so ago, because China kept faltering. Now suddenly there is this talk that China from these bombed out levels can give us a challenge for the money flows. Wanted your comment on that?
I think, of course, across the world, there are several markets, economies, asset classes, which will continue to do well at different points of time. As far as I am concerned, as a domestic equity investor, I think we have seen phenomenal compounding that has played out in the last 10, 20, 30 years. And there is scope for a lot more. I see no reason why the next 10 years should not be as exciting as it has been in the past. And therefore, we continue to be very hopeful of the India story and continue to invest in the markets.
Got it. All right. Varun, let's talk about a sector that you liked. I think IT. That was a theme that we had spoken about, I think, the last time as well. And you all were fairly constructive on that space. Capgemini came out with some guidance, and, they came out with their numbers last week. And suddenly everyone got very nervous. But I think a closer look into it said there's not much correlation between the two. And that's why the tech stocks have bounced back. After this recent run, still very positive?
Yeah, I think there are clear signs of revival as far as demand is concerned, especially in the financial space and North American geography. I think that was the space which was worst impacted because of last year's mini crisis, where a lot of mid-sized US banks went through a lot of problems because of the significant increase in interest rates. I think as the interest rate trajectory starts reversing, and hopefully this week too, we should get another rate cut from US Fed. I think as that trajectory reverses, we expect the US financial space to get better. I think most Tier 1 Indian IT companies have almost 1/3 of their revenues coming from the North American BFSI space. And I think discretionary demand is gradually coming back. The only concern remains on the margin side. I think next 2 quarters, we should start seeing some improvement as far as the margin regime is concerned. So I think FY26 onwards, we should see a healthy double-digit compounding in earnings for most Tier 1 Indian IT names, and some of the mid-cap names can do even better. So we remain quite constructive on the IT space from this point onwards.
Varun, so I mean, when you're looking at incremental addition from here on, just give us a sense. There's still a debate going on domestic earnings and whether the consumer sector is slowing down, especially middle of the rung consumption or the lower strata of consumption. And then there are the financials. I mean, today, look at the bank nifty. Financials are having a great run today. And that, I mean, no one's arguing the point that maybe there is a lot of valuation comfort in financials. But the issue is whether you will keep getting the growth runway and the margin improvement or not. So what is your stance on both of these pockets, consumer as well as financials?
I think as far as the lending financials, I think the worst is behind us. I think FY25 was a tough year because there were clearly pressure on NIMs. And if you look at the earnings growth for the Tier 1 banking space, this was a tough year with a single-digit growth because there were clearly pressure on margins. I think FY26 looks a lot better because we expect the credit growth to remain under control. We expect NIMs to bottom out and start reversing as the RBI starts cutting interest rates. I think we are also in a scenario where the credit growth has now converged with the deposit growth. So I think next year we would expect about 12-13% kind of credit growth. And therefore, it would be quite constructive on Tier 1 banking names, both public and private. And valuations, as you rightly mentioned, remains extremely attractive. So that's clearly overweight stance for us. As far as consumer space is concerned, there are clearly signs of some slowdown in the urban demand. I think some of the discretionary demand that we were seeing post-COVID is beginning to taper down, and therefore one needs to recalibrate the earnings growth as far as the urban discretionary consumption plays are concerned. As far as the rural plays are concerned, one hopes that with a fairly good monsoon, the demand is going to slowly start coming back. And in the next 2 quarters, we may see some recovery there. So on balance, I think one would be equal weightage kind of stance on the consumption space. But banking is clearly something which is very attractive. In fact, even the non-lending side, which is the asset capital marketplace, the AMCs, the depositories, exchanges, that is a very long-term, I think a 10-year story where as financial savings increase, more and more people put money in India in financial assets as compared to real assets or physical assets. And I think that thing should continue to do well. I think this quarter also we've seen very strong earnings growth on that side. And as long as we have a medium-term low inflation regime, which is a 3 to 5 year view of 4, 5, 6% kind of inflation, I think this financialization of savings should remain a fairly attractive story.
Is solar manufacturing a theme that you are interested in? You've analyzed. So we have manufacturers of solar panels, solar cells, etc.
Yeah, so I think this is clearly a sunrise industry as as we change from fossil fuels to more greener sources of energy. This is a space which is going to grow exponentially. One has to wait or one has to analyze what kind of companies have sturdy business models, what kind of companies have good clean management, which are able to look into the future and analyze and deploy the right technology. But clearly, along with some other new age sectors like EMS, contract manufacturing, this is definitely one space to watch out. I think we will see very fast earnings growth in this space, and that it's something that one should keep on the radar from a medium to long term perspective.
But do you have exposure in your portfolio to any of these solar/EMS, the sunrise industries that you spoke about?
Yeah, we do have some exposure.
You do have. To both of them, to both the themes?
Yes.
Okay. Thank you, Varun, for joining in. Let's move on now.
For more news and updates, all you need to do is follow CNBC TV18 on all of our digital platforms.